extended, the technicals simply won't
weigh that potential dilution against the upside. And
5,869 stories. Jane Street increasing their position just
technologies added 4.91%.
positioning. Someone was painting paper. Any rally runs straight into that brick.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
Friday, February 27th, 2026, Inuvo Inc. closes the trading session at $2.55. That is a massive single-day surge of 22.60%. And this wasn't just a price drift on thin air. We saw 807,250 shares change hands. To put that in perspective, that is significantly higher than the 20-day average of 262,030. For the technicians out there, the 5-day simple moving average just crossed above the 20-day.
A micro golden cross.
Exactly, a micro golden cross. Now, the stock does remain below the 200-day moving average of $3.45, but this kind of momentum tells me the market is finally waking up to the asset.
Well, it is certainly a pretty green candle on the chart. I'll give you that. But before we break out the champagne, we need to look at how that sausage was made. You're citing the total daily volume, but look at the last hour phenomenon. On that same Friday, the notional value of trades between 3 p.m. and 4 p.m. was $940,000.
Right.
That is nearly 12 times the average volume for that specific hour. And in the final 2 minutes, $26,000 traded instantly. That looks a lot less like organic price discovery and a lot more like market on close positioning. Someone was painting the tape. Plus, you have to look at the shadow inventory. The off-exchange short volume ratio on Friday was 62.86%.
I see the off-exchange data, but I really think you're misinterpreting the signal there. When you have that kind of volume spike alongside a 22% price jump, it signals a violent repricing of the thesis. The central question we are debating today isn't about one single hour of trading. It's about whether Inuvo's massive revenue contraction in Q4 was structural damage or, as I believe, a disciplined quality over quantity cleanup to prepare for an AI boom. I am taking the position that this pivot is a necessary evolution for their intent key technology, and the smart money sees it too.
And I take the position that a 47% revenue drop is catastrophic damage, regardless of the intent behind it. The microstructure we just talked about signals a trap for retail investors ahead of the March 5th earnings call. You have institutions hedging against a collapse while retail chases the momentum.
I think you are mistaking a renovation for a demolition. Management told us this drop was coming. They are intentionally purging non-compliant, low-quality traffic from the platform product line. They have to do this to build a defensible mode. And they secured a $6.2 million class action settlement, plus raised $3 million via convertible note with 3i LP. That ensures they have the runway to execute this shift without crushing shareholders. And the appointment of Rob Buchner as CEO on February 1 signals a shift toward operational scalability.
That narrative of an intentional pullback is convenient, but it masks dangerous volatility. The company's own admission was that the recovery has been more prolonged than expected. When over 60% of the short volume is happening in the dark pools, that suggests institutions are either selling into this rally or setting up for a localized squeeze that will reverse quickly. And their dependency risk is terrifying. They are living month to month on Google service agreement extensions. The latest one only goes to March 31.
Let's get into the specifics of why this revenue drop is actually a strategic positive, because the context really matters here. You're hung up on the raw Q4 revenue number, down to roughly $14 million, but you have to look at what Inuvo is actually selling. The entire ad tech world is undergoing a seismic shift right now. We are moving away from deterministic tracking.
The old cookie model.
Right. The old school way of using cookies to know exactly who you are. The industry is moving to probabilistic modeling. That is what Intent Key is. It refreshes its models every 5 minutes. It predicts engagement 24 hours faster than legacy systems. This is why they had to cut the junk revenue from the platform line. They need to focus on the high margin AI. Intent Key has an 80% gross margin.
I understand the technology, and I get why they want to pivot, but the timeline is brutal. The pullback was disclosed in late January, but the effects dragged right through Q1. Full year 2025 revenue was $86 million, up 3%, but all that momentum is completely gone now. You can have the best privacy-compliant AI in the world, but if you stop selling the thing that pays the bills before the new thing is ready to scale, you run out of cash. The market hates uncertainty, and a prolonged recovery is a massive red flag.
They didn't just stop selling blindly. They deliberately stopped selling the low-quality inventory that doesn't meet the new privacy standards of major platforms. If they had kept selling that traffic, they risked getting deplatformed entirely. That is where their new tools come in. Ranger automates compliance, and Intent Path gives clients visualization. These are value adds that prove the AI is actually working.
Launching new visualization tools and compliance AIs in the middle of a revenue collapse feels like rearranging deck chairs to me. Ranger is supposed to ensure ad quality. Great, but isn't that what they should have been doing all along? Why did they have so much low-quality volume to purge in the first place?
Because that was the nature of the legacy ad network business. It was volume-based. Now it has to be quality-based. And if you look at the institutional flows, the smart money validates this transition. Look at the 13F and import filings. Jane Street Group increased their position by 152.31%. They hold over 42,000 shares now. Renaissance Technologies added 4.91%. Geode added 3.10%. These are quantitative funds, algorithms that see a statistical edge in the recovery thesis.
I have to stop you there. You are conflating accumulation with market making. Jane Street and Citadel, who, by the way, cut their exposure by over 81%, are high-frequency trading firms. They provide liquidity. They don't buy a stock because they believe in the 5-year vision of Intent Key. They buy it because they see volatility they can arbitrage.
But Renaissance is a trend follower.
Renaissance trades patterns, not stories. Jane Street increasing their position just tells me they expect massive chop. And this brings me back to the dark pool forensics. On the day of that 22% rally, 225,869 shares were shorted off exchange. That is market on close positioning, not fundamental conviction. They are delta hedging.
Or it means there is massive institutional interest in the stock. If Jane Street is buying the underlying to facilitate trades, they might be shorting against it in the dark pools to remain delta neutral. Activity is better than apathy. And we have to talk about the balance sheet management because you hinted at cash flow issues earlier. They landed a $6.2 million class action settlement on January 29. That is non-dilutive cash. It is a windfall that creates a massive buffer while they complete this pivot.
The $6.2 million is a nice lifeline. It keeps the lights on. But let's look at the actual capital structure now. You mentioned the 3ILP convertible note. They just filed an S3 registration statement for the resale of 5 million shares. That is potential supply hanging over a stock that normally trades a couple 100,000 shares a day.
You have to look at the conversion price on that note. It's the key detail.
The conversion price is $3.10.
Exactly. $3.10. The stock is currently at $2.55. The fact that 3i invested with a conversion price set at 3.10 suggests they see the upside well beyond that level. The floor is set at 0.736, sure, but they aren't going to convert just to dump at a loss.
I see it very differently. That 3.10 level creates a hard, resistant ceiling. If the earnings on March 5 are actually good and the stock rallies to $3, 3i has every incentive to convert and flood the market with paper. Any rally runs straight into that brick wall of 5 million shares.
Every small cap growth company has financing structures. You have to weigh that potential dilution against the upside. Analysts have an average price target of $7.24. The valuation is completely disconnected right now. They are trading at a price-to-sales ratio significantly below their peers.
The market is pricing them based on risk. And the biggest risk isn't the dilution, it is their partner dependency. We need to talk about the gorilla in the room here, Google.
It is a relationship they've managed successfully for years.
It is a relationship that is hanging by a thread. On February 17th, their subsidiary, Virtro, extended the Google Services Agreement, but the extension is only until March 31, 2026. That is barely a month away. They are living month to month on the contract that underpins the entire platform business. If Google changes a policy or decides Inuvo isn't compliant enough, that revenue stream evaporates.
That risk is exactly why they are pivoting to intent key. The entire point of this strategic shift is to reduce reliance on the Google-dominated ecosystem of cookies and identity tracking. Yes, the Google contract is short-term, but high-frequency renewal cycles are standard for this legacy business. It keeps the lights on while they build out the cookieless AI.
What the future asset needs the legacy lights to stay on. If that Google deal lapses, it creates a binary event risk that is terrifying. You are betting that Rob Buchner, the new CEO, can execute a perfect pivot while walking a tightrope with Google and holding off a shelf offering. Swapping captains from Rich Howe to Buchner in the middle of a crisis is risky.
The transition to Buchner is about execution. He was the COO. He knows the AI operations inside and out. The exit with Howe was clean, even if it cost $682,000 in separation pay. Buchner isn't a sales guy puffing up numbers. He's there to scale the plumbing. I'd rather have $50 million of 80% margin AI revenue than $100 million of garbage legacy revenue.
If they can get there, shrinking revenue to find profitability is a very dangerous game in a growth sector.
Well, it all comes down to March 5.
It really does. That conference call is the binary event for this stock.
Let's summarize where we stand then. I maintain that Inuvo is deeply undervalued relative to its peers and its technology. The pain of the pivot is past. They have the $6.2 million cash buffer, the AI infrastructure is ready, and the technicals show the market is finally looking past the fear.
And I maintain that the 62% off-exchange short ratio and the 3i resell shelf create a massive sell-the-news setup. The Friday rally looks like a localized short covering trap, and the dark pools are positioning for gravity to take over if management admits Q1 is still transitionary.
I think we can agree listeners should be watching two specific metrics on that March 5 call. First, we need to see sequential revenue improvement in January and February to prove the bleeding is stopped.
Yes, and second, we need absolute clarity on the Google renewal terms. If there isn't confidence that the March 31 deadline will be extended, the technicals simply won't matter.
It is definitely a complex picture. Dark market mechanics versus fundamental AI progress.
Indeed it is. We encourage everyone to review the 13F filings and the S3 registration statement for themselves. Understand the capital structure before drawing your own conclusions.
There is always more to explore in the material. Thanks for listening.
Until next time.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!